First, thank you very much for coming tonight. With the great views, it's beautiful outside, but it's even better in here. So following two great speakers, very good quants, I'm going to talk a little bit about the power of events in a little different way. So we all heard why event data is important and the way you can use it. And there's been a whole bunch of academic papers using the Wall Street Horizon data. And tonight, I just want to spend a few minutes, very high level, going through the highlights of these papers, just pulling out a couple of nuggets on what they did and what were the results. Clearly, I'm not going to reiterate what Eric So did, and I can't do it better than he did. But you can see some of these other papers, and all of these are linked on our website. So, for more information, just go to our website and you'll see all these papers that you can click on, read an abstract, or read the paper. So Eric's paper, and he has one or two more coming, hopefully soon. A paper, Market Inattention and Earnings Announcement Timing, which I'll talk about, using option implied volatilities to predict stock returns. Is there news and timing of earnings? And public information and price discovery. Trade time versus clock time. So first, I'll talk about deHaan's paper, which is about market inattention. So the question Ed approached was, do managers control the timing of the earnings announcements? So Eric talked a lot about if the advances versus the delayers and what's the value. Well, are they intentionally doing something? Do they try to hide bad news? Are they trying to highlight good news? Do they have control? What type of control do they have on doing this? So this chart talks about when is there more investor attention? Well, it's all logical. I mean, before the markets open, there's a lot more attention than after the hours. There's more people, the day's beginning. The amount of earnings reports, the more earnings reports, the harder it is to follow all of them. The fewer there are, the more scrutiny you can have for them. So that's pretty obvious. The third one's a little more interesting, which is the day of the week. A lot of papers have been written in the past talking about Friday being a good day to hide information. There's not much attention on Fridays. And what deHaan found was, no, there's actually just as much price impact on Fridays as any other day of the week, which was a little surprising. This is a graph I just put up just to show you, his data from 2000 to 2011, and it's just talking about when the earnings announcements happened, whether it was before hours, after hours, or during hours. And the red line shows back in 2000, he had like 20% during hours. Today, or 2011, almost nothing is during hours. It's either before the market or after. No one wants to report during the market. So here's the percentage of earnings releases by day of the week. And you can see it increase from Monday, peaks at Thursday, and certainly goes way down on Friday. And I think that's part of the reason a lot of people thought Friday is a good day to hide earnings, that there's less attention, because there's fewer releases happening on Friday, but that's not what his data showed. So, what he concluded was managers do try to highlight good information, good news. They try to hide the bad news, and they try to sometimes hide the news on Fridays. There's more bad reports on Friday proportionally than any other day of the week. But he showed there was just as much market impact and attention to it on Friday. So that was a bad strategy. The next paper I'm going to talk about is by Shrihari Santosh of University of Chicago, which talks about trade time versus clock time. So what he's trying to determine here is, after the announcement, how long does it take for the price discovery? Specifically for him, if there's an announcement after hours, you have an after hours market, and then you have an open in the morning, what's happening to the price? Can you trade on this? How quickly does it incorporate the information? So this is a graph talking about an event. So it's kind of an event study, just like Dave talks about, which is, he has this impulse function which basically says how much impact is there in the price, without going into the math. So a lot happens before. So this is the close the day before. They announced after hours. By the morning, there's a ton of information already in the price that happened overnight. There's still a lot that's going to happen the first day. And there's even, in his event study, there's even some that's going to happen for the next few days. There's still more out there. But a lot happens overnight based on what he's looking at. One of the things he looks at that I'm not that relevant for me, but it's interesting, is this tick-by-tick information about how many trades do you need to get a lot of impact. And what he found is it's not time. It's not 10 minutes has to pass or 4 hours. It's the trades, the number of trades that happen. So if you have a very liquid stock, it could be 30 seconds, 2 minutes, where you get a high impact. Where if you have a less liquid stock, it may take quite a while to get the same impact, but it's based on the number of trades, is what he found. So to him, it's this trades versus the cumulative impulse function of how much impact there is on the stock. So he says information flows in trade time, not clock time. And for those reporting after hours, there's a very large impact that occurs the first night, is what he finds. The third paper I want to talk about is by Joshua Livnat from NYU, which is talking about option implied volatility and whether that predicts excess returns. So he's trying to ask two questions. One from an options perspective, is the options market correctly incorporating this excess volatility around the earnings announcement or shareholders' meetings? He does both. And the second question is there this excess volatility, does it forecast some type of excess stock return around these events? Well, without giving the conclusion, so I just made up a random price thing showing there's some event that occurs, and then afterwards you have some excess volatility. You don't know if it's positive, the blue, or a negative event, the red, but there's something in there. And what he finds is that the traders actually incorporate this information very quickly and very efficiently into the market. So you can't make money off of this as a trader. They do this very well. But in the equity markets, this information is not incorporated. The equity markets, just like Eric So's paper saying, you have this information and nothing's happening really until the announcement, even though you know something and you can make money off of it. He's saying the same thing, that there's value here, but you're not taking advantage of it. Now, if you have some type of model, whether you're fundamental or quant, and you have some inkling on whether it's good news or bad news, well, now you have two things. You have extra liquidity in the market, and you also have extra returns, excess returns. So with just a little information, you can make a lot of money around these event dates. The option market does incorporate it correctly, which was interesting. That was his conclusion. The markets are efficient on the option side, but not in the equity market. So, what does the whole thing mean for us is data is great, but you have to have good data. You have to have it timely and accurate. Otherwise, throw it away. Bad information gives you, you're going to lose. And so, corporate event dates contain information both for the option markets and for the equity markets. And we see they're not symmetric. The option markets incorporate it more quickly. The equity markets are slower to respond. Whether it's earnings, dividends, shareholder meetings, Wall Street Horizon 2.0, which is a whole bunch of data sets coming in the future. There's a lot of information out there. It's useful both for high-frequency traders, low latency, and it's for buy sides investors like me and some of you out there who want to hold things for a while. Livnat's paper, he shows it holding for 90 days out there. You got a long holding period. You don't have to buy it, and within 3 seconds. So there's a lot of information in there and value. So I want to thank you for coming tonight.